Okay, let's go ahead and get into the stock market technical analysis. We'll use the charts to be our guide, and we're kind of looking at what's going on. Obviously, we had the big rally yesterday based off of the election results. So we'll look at that and we'll see what the charts tell us, with that rally. So starting off with the S&P 500, I'll go into triple Qs next. The S&P 500, the bigger picture, what I'm seeing here is we had an uptrend. All right, there's the daily. There's an uptrend, nice clean uptrend. We had a breakdown, and then we created this bearish rising wedge. It's a very clean and clear wedge on the daily chart. You can see we've got several reactions really validating that and to that wedge on both sides. We broke the wedge, and then we have recovered the wedge. Okay, we did have a breakdown, and then the post-election pop has recovered the wedge, but we're pretty much right there, back at that resistance line of the wedge. And here's the thing: the Fed's coming out in just an hour or so, about 2 hours. The Fed is going to come out. And believe me, the Fed has the power to move the markets, and we're kind of right there at resistance. So was this just a false, it's lots of volatility for sure, because we basically broke down ahead of the election, gapped up after, and now we're rolling into the Fed. Could be another gap down. So there's kind of big moves going on. And, that bearish rising wedge still is intact. We had a breakdown, we had a recovery. Could just be kind of a pre-Fed recovery, and then it rolls over. Okay, the pattern hasn't been negated necessarily. I mean, the bearish rising wedge pattern is still intact. And in general, this is kind of stop rate price action. I mean, to me, it looks like it's really where are we at. Was this breakdown a real breakdown? Because it clearly broke outside of the wedge. Or is the recovery the real deal, and we're still in this wedge, and this is a false breakdown? So it's just a little unknown because of the volatility and because of the large market moving events. So we're going to have to wait to see what the Fed says, and mostly what does the market do with that? How does the market treat what the Fed says? For sure, they're going to cut 25 basis points. That's pretty much priced in. So that's for sure going to happen. But then what do they indicate in terms of future rate cuts, or, what they're looking at doing in the future? So that's really where the volatility is going to come into play. You'll probably see like a post rate cut pop, just kind of algos, but that's pretty much priced in. So any kind of pop on that initial rate cut announcement should get faded. And then when Powell comes out for his news conference, that's where the market will likely start to try to figure out what it wants to do next. Okay, so that is what I see on the SPY. Triple Qs, a couple things. One, post-Fed, we have made a new high. All right, there's your former bearish engulfing, kind of your former high in triple Qs. Made a new high on the Fed or on the election, and kind of building on that today. But again, this price action is happening right ahead of the Fed. So you definitely want to take that stuff with a grain of salt. Yes, we had the election, the market's rallying off of that, but that momentum can easily get either added to by the Fed or could get negated by the Fed. We still have negative divergence on the RSI and the PPO. Clear negative divergence there. Even right here, we still have it. All right, so we're making a new divergent high, which tells me that the probability that it's a high probability that this is going to get sold into. Now, it doesn't necessarily have to get sold into right after the Fed. Maybe that selling comes next week. That's possible. But there's a good chance that this move up here is a divergent high that gets sold into. All right. One way to play it, because again, the volatility there's high volatility right now due to the fact that we've got these big market moving events. This week was really a huge volatility week, and the week's not over. So the volatility still could play out to the downside. But obviously we had large cap tech earnings, we had the election and the Fed. So it's just a major week in general between this week and last week. Okay, so that is what I see on triple Qs. Right now, I mean, we're at all-time highs, so there's no resistance overhead. So that's basically, we can continue to go higher. We could have a blow off top, that's possible. As of right now, it's a divergent high, so I'm not leaning that way. I'm actually leaning towards it selling off. To see that, if we saw this price action after the Fed, let's say next week, the market just starts buying and it likes what it heard from the Fed and the volatility events are out of the way, it'd be a lot more believable than seeing it happen right ahead of major volatility events like the Fed. So that's the one thing I kind of want to throw out there. NVIDIA, this is, again, the big thing on NVIDIA is, support is the major trend line that has not been broken. So there's your support, and that has to go in order for any kind of major sell-off in the triple Qs. I've talked about that consistently. So again, there is the trend line, and we're well above that now. We are making a new high above the former high in that bearish engulfing, and yet that high is a divergent high. It's still divergence. Now, if we continue to rally and it keeps going up, we're going to burn through the divergence, and then you can't make the same case that there is negative divergence. But as of right now, that negative divergence exists, and it tells me that there's a very high probability that this high that we're seeing, the prices that we're seeing kind of currently, are about to get sold into. Tesla, this one is on a breakout essentially, because on the daily chart, you've got a clean downtrend line. You can see we had another reaction here, and even another reaction here that they faded. But then, obviously, with Elon Musk butting up with the president, you're seeing a breakout there. So no real sell signals in that one, and technically, in fact, it is a breakout. So this one could, we might pull back and test support, but it's really hard to say it's not a breakout until you see that fail, okay? Gold miners, obviously, these are on a sell signal. So we had a big gap down. You can see this big bearish rising wedge gap down here. They're rallying it up, so it could go up and back test. All right, that's possible, but it should get sold into on that back test. That's resistance. So rallies into resistance. When you have support that's broken, when you rally into resistance, that's objective areas to short for the next leg down. This is the more major move, should be to the downside. There's a handful of stocks that look like they're triggering today. It's just the problem is the Fed. You really want to clear that out, clear that volatility out to get a good idea, because you can see a lot of fake out moves right ahead of there. But here's one, just to give you guys an example. GE. On the daily chart, support. There's another reaction, and it broke support, all right? And the rally, the post-election rally, rallied it into resistance there. That's an objective short, and it's being sold into. So the Fed could negate this, okay? If the Fed, with what they say is bullish, and this recovers the trend line, that would be bullish. But until then, it's resistance and it's getting sold into, and it tells me this is headed lower. So I would assume probability says this is going lower until or unless you recover that broken support, which could happen. All right, definitely could happen after the Fed, but doesn't mean it's going to happen. Again, this one's really interesting. PNC, it's a regional bank. It's just interesting to see the price action right ahead of the Fed. You've got negative divergence. You have a bearish rising wedge. Post-election rally pops you up above to the top of the wedge. This, to me, all right, I've seen this many times. That looks like a stop rating move, okay? This post-election rally up here on this bearish setup runs all the shorts out. It's a stop raid, run a bunch of shorts out, and then the Fed's going to come out, and this thing's going to head lower. That's what the chart tells me it's going to do. Of course, it doesn't have to, but this looks like price like a stop rate. So what I would look for is, what does this do? I just would be on watch, because if you start to see this starting to sell off, then that's how I'd anticipate that. I'd anticipate that was a stop rate, and this thing's about to roll over in a meaningful way, and probably target all the way down here at 142-ish. Okay. And it's very bearish to see that, because you've run all the shorts out. All right. They get that big gap up. Stops are hit, you run a bunch of shorts out, so there's not a lot of shorts in there. And then if it starts to roll over, there's no shorts in there to cover to stop it from selling off. So it can sell off in a meaningful way. So that's what I'd be watching for. There's really no trade here until unless you see that starting to roll over. I wouldn't be taking this as a breakout right ahead of the Fed with negative divergence and a bearish pattern. I think the better move is to wait to see if it starts to sell off. And then here's FITB, very similar kind of thing. Big bearish rising wedge pattern on the daily chart with negative divergence. Even the new high, here's the post-election pop. Momentum just still can't make a new high. All right, it's still diverging. So that tells me that this is going to get sold into. Okay, now if momentum, if it was very strong, because it was like, and there's enthusiasm yesterday because the market's moving up, but there's really no momentum. The volume is not really consistent with the price action. So that tells me that this is going to get sold into. And if they rally it more and you break that divergence, that changes the technical picture. And in that situation, when you don't have divergence because it's been burned through, then it really changes that. And maybe this wedge gets negated too because you break to the upside. But as of right now, it does look like this is going to get sold into. And the target still remains 32-ish. There's no sell signal. But you did have that's a false breakdown. We got that right ahead of the election. Boom, pop it up. Okay, so now I think this thing's ripe to break down. But again, you need to see it break the bottom support there for that sell signal. Here's GM. Rallying obviously like the rest of the market. This one the momentum's not too bad, so it's not my favorite for shorting, but you do have a trend line to watch, and we're hitting resistance. You hit it there, and we're really right back at it. So we continue to kind of run up and hit resistance. The divergences, if you roll out, they are there, bigger picture. But yeah, momentum is okay. So I'm just watching it. Again, for the most part, I'm not really taking any new positions today. I'm really just waiting to see how things kind of dial out. And let's look at the bonds, the TLT. That one's rallying today. We do have a little bit of bullish divergence here on the daily chart. You can see we made a new divergent low. So if bonds rally, okay, then that should be bullish for the market because rates would be falling. So something to watch for there. Definitely important. And then if you look at the TNX, this is your 10-year treasury, those are coming down, but they're kind of coming down just to support right in here. So we'll see where that wants to go post-Fed, because the last time the Fed cut rates was down here in September. They cut rates and the interest rates just they just climbed pretty drastically. Interest rates went up 25% in terms of rate of gain right when the Fed cut rates. So if the Fed's going to cut again and they give indication that they're going to keep cutting, bonds are not going to like it and rates could keep rising. And if rates keep rising, it's very, very likely, regardless of who's in the presidency and all that and policies, rising interest rates will be bearish for the market. Okay, this market is built on cheap and easy money, and as rates rise, you should see that start to get reflected in stock prices. So something I'm watching there is these interest rates. Here's kind of an example. The home builders, they've started to take notice of the rising rates. Little back testing rally now. But look, you've got a bearish rising wedge. All right, you've got negative divergence. The widest part of the wedge is projected. It's this blue line that I have marked out. But it's basically, you take it at the point of the breakdown, it's projecting we're going to head down to 105. And as of right now, this looks like a bear flag. Okay, so that tells me we had a push down, little counter trend rally, continuation move to the downside to that measured target. So that's where I think this is going. All right, the home builders are going that way. I suspect the home builders are only going to be going down like this if we're seeing interest rates rise. Okay, so it's kind of all pieces together, but if those rates are rising and the home builders start falling, and you're going to see triple Qs and those tech stocks roll over as well. And they have a ways to go because everybody's piled into those. All the longs, all the bulls are piled into the mega cap tech stocks. So they have a ways to come down if they are going to start to sell off. So a lot of this is kind of conditional. You know, everything's really conditional. But this chart, this is a bear flag. And it can be negated. But as of right now, the probability says that on a bear flag, the way you do it is you kind of take the flagpole, all right? And then you mark it out at the flag. And that gives you kind of your projected target. And we have that wedge. And so everything is kind of setting us up for a push down to that area on the home builders, which tells me rates are probably going to rise because the home builders are likely not going to continue to sell off unless the interest rates keep rising. The longs that I like, NTR, again, this one gapped up on earnings, or I guess just ahead of earnings, gapped up and kind of hit that resistance level that I had marked out right up there. Also the 200-day, but it's already hit the 200-day once. Hit that resistance, then they failed the 200, and we're kind of back down near support. Maybe could go a little lower, but in general, it's kind of near support. So this one, I think it still continues to look like a good long, and it's going to continue to grind higher. And then the other one I pointed out, MOS, this one still looks good as well. This one has a bullish falling wedge, big long bullish falling wedge with bullish divergence. And we had a breakout. All right, so that wasn't really a breakout. You can see they were kind of battling it out here. The breakout really came right there on the big gap up. That's a breakout. Ran down back to support. Buyer stepped in, and we're back up near kind of resistance, basically. So could chop around a little bit more. But in general, I think this one's going to continue to go higher. Should take out the 200 soon. And then the measured target on this one, I have it marked in blue up here, but it's the widest part of the wedge. All right, it's a big wedge. And you take it at the point of the, I've got it marked in red. And it's right there. 41.60 is the major target in this one. So I like that as a long trade for continued upside. Okay, so we're going to just kind of wrap it up here. Again, it's really hard to take any real big positions or take any major position stances right ahead of the Fed. So just want to give kind of the outlook of where things are at now, where they look like they can be heading, and then also really just what to watch for in terms of how to react and post-Fed. So, and then we'll have a lot more information next week as we start to clear out all these volatility events, and we're going to really get a good read on where the market's likely going to head after that. I mean, if we get a big sell-off after the Fed, the momentum and everything, the hype and the mania of the rally that's there as of right now it'll be gone. So things can really move quickly on just kind of a day by day basis, and it doesn't have the way things are in this exact moment doesn't mean they're going to be like that come Friday at the close. We could build on it, we could build on the momentum, or we could negate it. So we'll see, because in general, we just have to wait for the market to tell us where it's going next. All right, I'm going to wrap it up, get the video out, catch you guys on the next one.